we have Amazon, Apple, Meta, Google, AMD, Starbucks, McDonald's, then a bunch of smaller companies like Spotify, Snapchat. We have Atlassian. All these companies are reporting earnings this week. And in this video, we're going to be talking about it. In fact, we can look at the list this week. This is the most anticipated earnings of the week. And what I've done is I've even filtered it down to the ones that I personally think are the most interesting, that I think most people are paying attention to. We have one this morning that was SoFi. I think that's the only really interesting one today, but we get into the more interesting ones starting tomorrow. Tuesday before market open, we have McDonald's, we have Spotify. I'll be giving my opinion on how restaurants and quick service restaurants are doing, as well as Spotify. We haven't checked in on that company for a while, so I'll give my updated opinion on that. Then after close, we have AMD and Snapchat. Snapchat's one of those companies I've highlighted many times for being unprofitable, paying the executives a lot of money, not really having a sustainable business model as of yet. So we'll be looking at that one as well. Then we get to some other ones that they've gone through a tough time. Peloton has gone through a very difficult time. This is one as soon as I saw demand issues, I sold out of the company. I actually sold Peloton at a 100% gain. So I was one of the few that I got out of that one pretty soon after it hit the peak, and I locked in gains. Since then, this one has just gone down further and further. It's really struggled. After Peloton on Wednesday, after market close, we have big tech. We have Meta with the ad business. And this is going to be a huge earnings report, and it will set up for Google. So you're going to see Meta and Google trade very similarly after Meta's earnings report. Then we have the big day, which is Thursday. This is where a lot is going to happen. This is going to be a big determining factor of the overall market, the overall sentiment on the economy. Amazon's reporting, the retail juggernaut. They basically are the weather vane of how the consumer's doing, how spending's doing, how online retail's doing, even how the tech market's doing with AWS. So much is told from just Amazon's report, and I'll be giving my prediction, which I think is very informed on this subject. I've spent a lot of time thinking about Amazon, so I'll be going over what I think is going to happen in this report. Then we have Apple, biggest company in the market right now. They're reporting and they're facing a slowdown in iPhone and hardware demand because Microsoft already reported and they had a big slowdown in hardware. Then Starbucks, another quick service restaurant, and Atlassian, the last company that I want to check in on. Now let's go ahead and jump in, and we'll start off with Tuesday and work our way throughout the week. So tomorrow before market open, we have two companies reporting earnings. We have McDonald's and Spotify, very different companies. So we'll start off with McDonald's. What I'll say about this company is I have a portfolio that I don't show on this channel often, but it's called the passive income portfolio, where I focus on high quality compounding companies that I think have incredibly good profiles of profitability, of growth, of risk structure to them. I think they have very low risk relative to the rest of the market. And I buy heavily into these companies and watch them compound their intrinsic value over time. In this portfolio, I have a category called restaurants. So I have actually looked at this industry extensively because I put a lot of my money in this industry, $40,000 worth into Texas Roadhouse, a single restaurant. And then I put up to $30,000 into Starbucks. I've trimmed this position a little bit as it's gone up closer to its fair value, but I still have $17,000 in Starbucks. So I have a combined total of almost $60,000 in the restaurant category. That's a ton of money for me. So I've done a lot of research on this category. And what I'll say based off my research about McDonald's and their upcoming earnings, I think it's going to be good. I think McDonald's is likely not going to disappoint investors too much. When I looked at different restaurants, there's basically two different categories. There is full service sit-down restaurants. That is Texas Roadhouse. I think Texas Roadhouse is the best in class of full service sit-down restaurants. They are operationally excellent. They're efficient with free cash flow. They are investor friendly. They have an incredibly good value proposition for the consumer. So I think this one is going to be a winner of that category. Sit-down full-service restaurants. But then there's the other category. There is quick service restaurants. This is where you take stuff to go. You don't sit down and you don't have a wait staff. So companies like Chipotle, Starbucks, Burger King, Wendy's, and McDonald's, those are quick service restaurants. So this is more similar to McDonald's than Texas Roadhouse. They're in a little bit of different categories. Based on my research of Starbucks, I think it's going to do very well this year. I think that McDonald's is likewise going to do very well this year. I believe that the consumer has evolved over time to love having their morning routines, to love having their morning coffee, to love having their morning breakfast on the go. We lead busy lives. We're going to and from work. A lot of us don't have time to wake up and make breakfast for ourselves every morning. Starbucks offers an addictive, caffeinated drink that people are unwilling to give up. They're unwilling to give up during recessions, during job loss, during a lot of this. I think a lot of people still have their Starbucks coffee. And likewise, when I look at McDonald's, it looks like a pretty bland company, right? Boring old McDonald's. It's a highly defensive company. The revenues don't seem to be growing all that much, right? They've kind of gone through a peak and the revenues have flattened out. McDonald's is an operationally excellent company. They're at the top of their game. The things that they're doing with their restaurants, the things that they're doing with the to-go ordering, the things they're doing with their app, it's all, I think every move that they're making is fantastic. And this year in particular, in 2023, I'll make the same prediction I did last year. I think that full service sit-down restaurants like Texas Roadhouse and quick service restaurants, especially well-ran ones like McDonald's, will do exceptionally well. It's not the best food, it's not the best quality of food, but that's not what customers are looking for. They're looking for quick, convenient, cheap, and a consistent meal every single time. And that's what McDonald's does. Now, the only warning that I'd give with McDonald's is that it is already trading at a price that has relatively high expectations, a 26 forward PE ratio. This company is considered defensive, and we've already been in a very defensive market. So a lot of these companies like McDonald's have done well over the past year. They're already bid up to a pretty high price. I think it will continue to perform well, but I don't know how much more immediate upside there is. Now, moving on from McDonald's, we have before Tuesday market open, Spotify reporting their earnings as well. Spotify is a company that I have had in my tech portfolio. I love Spotify. Even though I'm an Apple fanboy, I have Spotify. I think it's just better in almost every way. The handoff between devices, the interface, I think the algorithms that they have that make the playlists, I just think it's a better product than any other music product out there. So I love Spotify. I love the platform, love the application. The reason that I actually sold out of this company and moved it out of my portfolio is because I decided that I was no longer doing any amounts of speculation in my portfolio. I raised the standards of it. I said, if a company is not making money, or I don't have 100% confidence that they're going to make money within the next 2 years, then I'm not investing in the company. So for a company like Netflix that is making the curve of going from being an unprofitable company to being free cash flow positive in a single year, I had that one in the portfolio because I was so incredibly confident that Netflix would become free cash flow positive in 2022. And they did. They had $1.6 billion of free cash flow. Spotify, on the other hand, if we look at this company's financials, I'll just zoom in here so we can see it clearly. They have growing revenue, like many of these companies do, right? There's lots of tech companies that have growing revenue. I've gone over this before. Revenue shows how much money they're taking in. It doesn't show how much money they're keeping. And Spotify has a lot of disadvantages that other companies don't. Spotify has a ton of variable costs. They have to share all of their profits with the music that they're streaming, with the music labels. When we look at their actual free cash flows, if we look at it annually, this is what it looks like. It's positive. But we know by now that we click on this middle toggle here and we see the stock-based compensation, which is basically, in my opinion, how they're paying their employees. It's not really even opinion. That is how they're paying their employees. If you actually factor that in, the company's not really making money. They barely have any more money in 2021 in free cash flow than stock-based comp. They did $276 million in free cash flow, and they did $223 million in stock-based comp. So you net that out and you get a company that made $50 million in free cash flow in the entire year of 2021. $50 million and a company's market cap that's $19 billion, almost $20 billion. And then if we even look at quarterly, so this is what it looks like with the last 3 quarters, starting right here. Again, we can zoom in on this and just look at the numbers here. This is the last 3 quarters right here. We have Q1 of 2022, $68 million in stock-based comp, $27 million in free cash flow. Q2, $34 million in free cash flow, And then we have 105 million stock-based comp. And basically the same thing in Q3. The company is diluting shareholders more than it's making money. And the story with Spotify is frustrating because I love the product. I love the company. I even like the founder of the company. I think he's a very intelligent guy. It's a founder-led company with the same founder leading it today. But even then, I still need to have the company actually make some money. So what I'll be looking for in this earnings report is I'll be looking for profitability metrics of the company, operating leverage, scalability going into play. If they report and they just say, look, we gain more users, we have more active members, we have more monthly listeners, our podcast grew, that's great. They've been saying that for literally years, quarter after quarter. But I want to see actual cash flows. I want to see the company exercise operating leverage. Maybe they're doing that. We had a report that they're laying off some employees. They might be focusing on that more. But in my opinion, I just look at the charts and I think right now Spotify is just a bit too early for me to jump into. It's just a bit too speculative of a bet. Now, a lot of investors are okay with speculative bets. They like investing in companies that are a little bit less predictable. In my case, I've strongly moved out of that camp, and I'm okay missing the first move. Spotify's up 25% year to date. That can cause FOMO, the fear of missing out. You can think that you have to jump into these companies really early, otherwise you miss all the gains. That's not really the case. And most of the time, from what I've read from very good investors, it's okay to wait until a company becomes profitable. Peter Lynch never jumped into unprofitable companies hoping that they'd turn around and become profitable. He waited until they were actually generating profits, and he said that it was incredibly risky to invest in unprofitable companies. And I think that's the same case with Spotify. So in terms of my predictions, I think Spotify is going to have another similar quarter where they grow all of their metrics, but their profitability still is weak. It's weak and struggling. And until that changes, I'm going to sit on the sideline and I'll have it on the watch list. Now, moving on to Tuesday after close, we have AMD. A lot of investors, they'll ask, Joseph, why don't you invest in AMD or NVIDIA or any of these companies? The reason that I avoid the entire industry is because I don't like the industry in general. I think it has too many operational risks. I think it has too much CapEx, research and development. I think the competitive landscape is not great. It's very intense competition. And I think that a lot of investors underestimate the risks in these type of businesses. We've seen what happened to Intel. A couple years ago, Intel, they're on top of their game. Like they were the biggest one by far. They were leading the pack. They had Apple as a client, and then Apple ditched them, and then we've seen everything unfold. So I just think this industry in general has a lot of risk, a lot more risk than I like in my investments. Now, in terms of predictions, I think that the PE ratio is too high for this company, AMD. An 18 forward PE is right in line with the rest of the market, when I think AMD is a more risky company with its future projected cash flows than the rest of the market. The free cash flow yield is also pretty high for a company like this that's a cyclical company. I think investors have largely forgotten that these type of companies are cyclical. And what's happened over the past couple of years, in my opinion, is likely not going to be sustained. I said this for Google before Google had a big reversion to the mean, that this type of parabolic growth, when revenue just shoots up with no end in sight, that's usually not going to sustain. And I think what we're seeing right now in Microsoft and the slowdown in hardware, I think the slowdown in the gaming division, I think it's going to hurt AMD. We look at the cash flows of the company. See what I mean here in terms of cyclicality? If you're just zoomed into the past year and looking how great the company's done, that does not paint a full picture of this type of industry. The industry zigs and zags between profitability and money losing every couple of years. And this is a highly cyclical industry. Now, there's people telling me that this is done, that AMD and NVIDIA are no longer cyclical. There's too many chips in the world that they need to create. That may be the case, but I'm the type of person that I like hard evidence. I like knowing that it's completely done before believing people's projections of the future. And based off the history, even the recent history, just the past 20 years, it still looks like a very cyclical company to me. It's also one that has an enormous amount of stock-based compensation. They have dilution because they have to pay employees a lot of money. AMD, Intel, NVIDIA, Apple, all these companies are trying to get the best people to work for them, and that's expensive. They have to pay them in stock. So you have a company that also has high R&D expenses on top of that, continually doing research and development. So overall, in my opinion, This industry for me is still in a void. I have not been convinced to jump into it. I think the risks are too high, and I think that the risks outweigh the potential upside. I can find upside in a lot of different companies, a lot of different industries that I don't think share in this many risks. And in terms of this upcoming earnings report for AMD, my opinion would be that it's likely to disappoint, just based on the fact that Intel reported and it was a massive disappointment. We had Microsoft report and say their gaming division and hardware division slowing down like crazy. So maybe AMD is an outlier. Maybe it will surprise to the upside, but in my opinion, I'd be concerned going into this earnings report, owning this company. Next up, we have Snapchat, reporting again Tuesday after market close. Snapchat is a company that I've made fun of before because of its fundamentals. The fact that this company has rewarded the insiders of it to a massive, massive extent, and the retail investors have really drawn the short stick. So this is a company that has clearly rewarded the executives, the insiders of the company, the people that IPO'd the company, and then all the retail investors have just been devastated. It's been horrible for them. This year, it's bounced up. I think that this should not be celebrated. I think a lot of investors are patting themselves on the back for holding these type of companies. In my opinion, I don't think the day of reckoning for these type of companies has already come and gone. I think there's going to be more pain. You look at all time for Snapchat, and it's down 55%. Because the company struggles with one pesky thing, and that's making money. And when you go year after year after year without making money, and you have promises of the future of making money, investors will only tolerate that for a certain amount of time. Over the past couple of years, the market and the easy monetary policy, the low interest rates, have been very forgiving of a lot of investing sins, a lot of investing problems that have only been highlighted with higher interest rates. So right during this time period of easy money, low interest rates, investors that were very tolerant of dilution, they didn't really care, a lot of that landscape has shifted. And I don't think it's going to shift back anytime soon. I think the investors that are bidding these companies up, hoping for another bubble and another huge bull run in low quality companies, I think they're going to get hurt. So we look at Snapchat's fundamentals, and it used to have fast revenue growth, 40% over the past 5 years, but like a lot of companies, it slowed down markedly. I mean, it slowed down to 5% revenue growth year over year last quarter. So the revenue growth has basically flatlined. It's now just a slower growing company. The EBITDA is continually negative. So we have negative EBITDA, we have negative net income, we have negative earnings per share. If we look at the free cash flow, they do have some quarters where they're posting positive free cash flow. We factor in the employee expense and it's not even close. This is a company that's not making money right now, and you should know that if you're investing in it. It's a $17 billion market cap that currently doesn't make any money. Beyond the cost of paying their employees, they make none. Now, if you're investing in a company like Snapchat, you still can have an investment thesis. It just needs to be based off of a thought that this company will soon hit scale, and it will have massive operating leverage, and it will have a high amount of explosive profitability growth. That's basically what you're predicting here. And based off of their projected earnings, that's what a lot of analysts are predicting, that in 2023, their earnings per share are going to grow at a rate of 144%, from 14 pennies to 35 pennies. So the earnings per share are going to go up a lot, and that will make the forward PE go down to 31. So you can invest that way. You can buy the company now, hoping that they can have that operating leverage kick in, that they can have the earnings grow. I think that's a bet you can make if you really have an in-depth knowledge of the company and their fundamentals. In my opinion, I still consider it incredibly risky. For that reason, I would not have it in my portfolio. I think it needs to prove a lot more before it would reach my standards. Now, Wednesday, before market open, we have Peloton reporting earnings. Let's go ahead and take a look at what Peloton's been up to. This is a company that at one point in time, I had in my portfolio. It was a speculative bet. It wasn't a huge one. I had $1,000 that I put into it. It quickly doubled in price from a $7 billion market cap to a 14. Then it even went up all the way to a $20 billion market cap. And I thought it was getting a little bit ahead of itself, but I held on to the stock. Then the company started to run into trouble. The first signal that I knew Peloton was in trouble was when they lowered prices. That was such a red flag to me. Peloton was always viewed as the premium workout device. There's people having them delivered to their house. They were a status symbol. People posted them on Instagram. They had them in their living room, right? Pelotons were kind of this cultural phenomenon of a status symbol. And once I saw them lower prices, I just thought that there's no way they'd lower prices if they maintain the same demand. And I sold out of the company, the whole thing. I sold out at a 100% gain. So this is actually a case where I made some money on this company. I put out a video the day that I sold the company saying I'm selling 100% of the stock. I outlined the reasons why. And at the time, it was still a debatable decision. A lot of people said I made a mistake. Of course, the stock has gone down even below my original buy-in price of a $4 billion market cap. So not only would I have lost all 100% of my gains, I would have actually been in the red on this company. But regardless, here we are with Peloton once again. The valuation has come down to reality a little bit to reflect the fundamentals and future prospects of the company. It's no longer a $20 billion market cap. It's a $4 billion market cap. Still a big company, but a little bit more reasonable. This is one that, like the other ones, like Snapchat, it's in that category of being a money-losing company. But it is showing some prospect of moving in the right direction. And that's because of the new CEO that took over is very focused on cutting costs and actually running the company in a profitable way. Now, this is again something that's concerning to me. The company is up 56% year to date. And a lot of investors that have picked a couple companies and they see them run up like this, they pat themselves on the back for making a brilliant investing decision. This isn't reflective of the fundamentals. The fundamentals have not improved by 56% over the past 3 months. It's just the market. The market trades in crazy ways, so I would not use this as evidence of making a great decision over the past 3 months. The revenues of the company are declining, the EBITDA has been continually negative, and the free cash flow has been negative, but it's moving in the right direction. If you factor in stock-based comp, it looks even worse. So again, another more speculative company. A lot of the hype has been taken away. And when the hype goes away, a lot of investors get hurt in these type of companies. That's why I've decided with my portfolios a long time ago, over a year ago, I'm not doing any more speculation. There's no more gambling in my portfolio to any degree. And even though this can look exciting over the past 3 months, you look out just 1 year, it's down 54%, right? These type of companies are crazy. Over the past 2 years, it's down 91%. Devastating losses. So in terms of Peloton's earnings report, I'm not going to make a prediction either way. I think it's flipping a coin. I think it's highly unpredictable, and that's part of the problem of the investment. So if you're investing in this type of speculative company, just realize you're speculating, and I'd size the position appropriately so. Now, next up, we have Meta reporting earnings Wednesday after market close. This is a big one, and I think they're going to do well. I think it has more upside than downside by a large extent. Why do I think that? We had one big tech company just report earnings already, which is Microsoft. A lot of people don't realize that Microsoft has a massive advertising business. They have Bing and they have LinkedIn. And out of their report, there's all different businesses that did well and did poorly. The hardware business related to gaming did poorly. The Microsoft Azure business did really well. The LinkedIn part of it was a bright spot in Microsoft's earnings report. I mean, it really did well. It grew like crazy, 26% year over year, 29% constant currency. And so when I'm looking at Meta, it is an advertising business. And the only real data we have so far is that out of this massive company, Microsoft, the advertising portion, or at least part of it, which is LinkedIn, they have some other products, but a lot of it is advertising, did really well. So I have to assume that there's more upside on top of that. Another thing that I think allows for more upside and leniency with this stock is the price of it. It trades at a pretty low valuation. The PE ratio right now is a 15 forward PE, below the rest of the market, and it's trading more like a highly cyclical, low-quality company when I don't really view Meta that way. I don't love social media companies. I don't really love the category, but I consider Meta one of the higher quality social media companies. The free cash flow yield is 6.62%. It's a very high free cash flow yield, very low PE ratio for a company that I think won't do quite as bad as investors are expecting. And in terms of the whole metaverse and throwing money into CapEx and that problem, well, Mark Zuckerberg released a letter a few months back that I think really addressed those issues. So I think with Meta, we're likely to see more upside than downside. Having said that, I can't see the future, so don't make bets based off of this. Now, after Meta, we have the big day, which is Thursday. This is the one everyone's paying attention to. We have Amazon, Apple, and Google all reporting earnings Thursday after market close. Now, before we even jump into these earnings reports, we can start off with Amazon, but I have to make it clear that I own stock in Apple and Amazon. With Amazon, this is a fairly large holding. I've invested a lot in this company. I'm currently in the red by 25%, and the holding value is $45,000. Now, I think that Amazon is significantly undervalued. I've been buying the company anywhere from $80 per share up to $170 per share. And I think that all of those buy ranges, every one of them has been undervalued buys. Even though the stock is highly volatile, it trades 10, 20% sometimes in a single day. I think the intrinsic value is compounding for this company quarter after quarter, year after year. The intrinsic value is getting higher and higher. And at a certain point, that will become visible to the rest of investors blatantly in the numbers. Let me go ahead and show you how I think this will show up. We look at Amazon here, and again, this stock is just incredibly volatile. So like you look at the price, like a lot of these companies, it's traded down over the past year with these jagged spikes in price and then it trading further down. And a lot of that has to do with the simple cash flows and how they look right now. Amazon is a massive company with a market cap of $1 trillion. So you have a very big company, and what is the company actually doing right now? The company's losing money. So you have that combination. Big company losing a lot of money. Big market cap with no profits, right? Not a good combo. You factor in stock-based comp and it looks even worse. A big company with growing expenses, growing employee costs, growing CapEx, losing money. That's what investors are seeing right now. What I see is a company that has a significant amount of provable operating leverage. Operating leverage means that every additional dollar of revenue improves the margins of the company. But this can swing in both directions. So if the company has a lot of operating leverage, that can sometimes, if they do a lot of reinvestments, that can sometimes throw the actual cash flows in the red. And this is what Amazon repeatedly does. So I look at this and I look at the past couple of years of Amazon and the data that we have here. And this is operating leverage in full display. In 2018 to 2020, the company put up about $64 billion of free cash flow, with it growing double-digit percentage every year. That's because Amazon was operating in a normal environment. Then what happened in 2020 is fairly obvious. We had COVID, we had people have a demand surge for online ordering because they couldn't go to retail locations. Many people started using Amazon. So Amazon had a decision to make whether to double the size of their fulfillment network, which they know would throw their free cash flow well into the red, negative free cash flow, and that would fulfill all these orders. It would make customers happy, but it might make Wall Street upset because the profits will look horrible. Amazon, being the company they are, chose to do just that. They chose to overshoot it, build out too many fulfillment networks, hire too many warehouse employees just to make sure that they fulfill their orders at a timely manner, that they still keep their fast shipping as much as they can. And that's why the free cash flows moved into the red. The company literally doubled the size of their fulfillment network in a single year. And they're one of the only companies that has the money to actually do this. The only one that can feasibly do this is Walmart. So Amazon makes these huge, bold moves that throws their free cash flow in the negative to still make their customers happy, to make their logistics network bigger, and to keep customers shopping on their platform. When we look over the past year, we can see the explosive growth. It's much quicker than Walmart or Target or any of these other retail companies, and they're actually keeping it. Even though they had this explosive growth, they're actually holding it. It's not reverting back down. That's the incredible thing here. And the thing that I track, the way that I think that Amazon builds intrinsic value year over year, and they compound year over year, whether the stock price follows or not, is that this revenue is mostly from retail. And I view retail as the Trojan horse of the better businesses that Amazon has. So retail's like this, just this low quality business, right? You have retail that's low margin, highly competitive. It's a lower quality business based off of the fundamentals. But as they grow the retail, they grow their grasp to introduce their shoppers into other higher quality businesses. One of them being the ad revenue business, which is taking market share from Meta. It's taking market share from Google. And I think that that trend will continue. And then of course, the other thing is the AWS business. I keep track of a couple things here on a spreadsheet regarding Amazon's AWS business. We have in blue, the blue bars are the commitments, which are financial agreements, they're contracts with customers that want to use AWS for 1 year plus. A customer might sign a contract to use them for 3 years at a 30% discount. That way, AWS has a lock-in on that customer, and they build more and more of their stuff on AWS's platform. The other thing is in red, which is just the revenue. So you have the contract commitments and you have the revenue. If we look at just AWS's revenue, you can see that it's growing incredibly fast. This is not year by year, this is quarter by quarter. So the revenue has literally doubled since just 2020. Couple years and it's actually doubled. So this is the compounding that I'm talking about. Whether or not the retail side of the business grows or shrinks a little bit, 1% to 2%, whether they hit their metrics, that's not the most important thing. What I'm looking at is a compounding of AWS, which I think heavily compounds the intrinsic value of the company. And I'm also looking at the ads business, which is built upon the retail business, but that's the higher margin profit center of the retail business. So when a lot of people look at Amazon, they're going to be paying attention to the free cash flow metrics, the earnings per share. Those are the top line metrics everybody jumps to. What I'll be paying attention to mostly is the ad revenue of the company, the AWS business, and how the margins look and how the growth looks. That's what I think is compounding the intrinsic value of the company to the highest degree. And this type of stuff, the CapEx of the business, I don't expect that to be great this quarter. I think that it's going to take a long time for their CapEx to come back into control, where that nets out. But in the meantime, those other core businesses I think will be growing. So in my opinion, I still believe that Amazon is significantly undervalued. I think the businesses are going to do superb. I think advertising is going to do well. I think AWS is going to do well. There might be a minor slowdown in contracts because a lot of companies are concerned about a recession, but I consider that a short-term issue. I don't think that's a big problem. And then we'll see from there with Amazon's online retail of how the consumer is doing. If I had a guess on that front of how the general consumer buying retail is doing, I'd have to say really good. I looked at Visa and MasterCard's earnings and both of them say the consumer is spending money. So they're a little bit of a tell, and I think that Amazon's retail is likely to do just fine. So I'm bullish on Amazon's report. I think overall it probably has more upside than downside, but I'll have to give a reaction after the earnings report. Now next up we have Apple reporting earnings the same time, Thursday after close. Biggest company in the world, $2.3 trillion market cap company. It's also a juggernaut. It makes incredible amounts of free cash flow, just consistently incredible amounts of free cash flow. And it's one of the rare companies in big tech that has not done any layoffs. They exercise discipline with their hiring approach. Their stock-based compensation makes up a very low percentage of their free cash flow. So this is a company that's also very disciplined with their corporate governance, with their compensation policy for their executives, with their hiring approach. I view Apple as a very well-governed business, especially in terms of big tech, where there's a lot of waste. Now, Apple's a company that I do have a significant stake in. I've owned it for years. I'm significantly in the green. And it's a company that I've said time and time again that I think is undervalued. And I think investors view this company incorrectly routinely. They continually view it incorrectly. Investors have been viewing this company as a discretionary consumer electronic company. Like you go to the store and you have your TVs, you have your you have your Blu-ray players or whatever, right? We don't use anything but streaming anymore, but just discretionary items, right? Headphones, computers, TVs. That's not what Apple is. And that's the wrong way to view the company. The iPhone is not discretionary. If you ask anybody, would you be okay just leaving your iPhone home for the day? Like just try going a day without the iPhone. They can't. People mentally can't. It's with them all the time. It's a part of someone. It's crazy to think about leaving your iPhone for a single day. Now, products that you can't go a minute without having them, those are not discretionary. Those are staples. It's like toilet paper. It's like having a baby and having no diapers. There's some type of products that you have to have. Doesn't matter, you have to have it. The iPhone and the products that Apple makes, that's what they own. They own a consumer electronic product that is a must-have. It's like having a consumer staple company with better economics, because Apple's found not only how to sell iPhones, but how to monetize their users once they have the iPhone to a huge degree, with both their in-app purchases, having a toll bridge on that, charging the 30% or 15% Apple tax, and They, of course, have all of their different services they sell. And that's the story of Apple. That's what I'm looking for with this business. We know that they can sell iPhones. Whether demand wanes with the iPhones for a year, whether it's strong, who cares? They can sell iPhones. That's established. The story that is not yet established is how powerful Apple can be of a service and subscription-based company. That's what I think investors should be paying attention to. Forget about the iPhone demand of the iPhone 14 Pro or whatever model. Who cares? It can be a little weak, it can be a little strong. That's not a changing factor in Apple. That doesn't give you an edge in the investment. What can give you an edge in this investment is understanding whether or not their services are going to do well. In my opinion, I think that Apple has done an incredibly good job at growing their service business, and I think that we're going to see a larger and larger percentage of their profits, their revenue, come from services. Services like Apple TV Plus, like Apple Music, like Apple Fitness, like the Apple Care, their insurances, and their App Store. All of those combined are their service businesses, and I think they're going to do exceptionally well. So I'm still bullish on Apple. I own a lot of the company, and I'm still going to hold it. I'm not selling a single share. The company has a good free cash flow yield, great governance. I think the company is right now at a very minimum fair value. I think still slightly undervalued. I know it's crazy to say that because it's at 143, but I still think that Apple's slightly undervalued. So that's my thoughts on Apple's earnings. Now, of course, we can't forget Google, the last big tech reporting earnings the same day, Thursday after market close. What I'll say is what's happened the past couple of quarters has been frustrating. Snapchat will report earnings, and this company will report like terrible earnings, and then it will drop Meta and Google, as if Snapchat is the decider of whether or not the advertising business is doing well or not. So I hope that doesn't happen because it's not really accurate. Snapchat is not a good indicator of whether or not Google is doing fundamentally well, or Meta for that matter either. But either way, Google has gone through a lot of challenges. The company, I think, remains very cheap. It's at a 17 forward PE ratio. It has a very monopolistic type of business with search. It is getting challenged from Microsoft and others, but I don't think that's going to change anything real quick. The free cash flow yield is also 4.8%. When you net out stock-based comp, it's more like 3.8%. So it's an attractive free cash flow yield, but it's not as crazily undervalued as when you factor in the stock-based comp. And that is a problem that Google's dealing with right now. They hired too many employees. I've said that for over a year, that they're just hiring, and I don't understand why. Well, they've realized that's a problem. They're cutting back on the employee count. But one thing you have to keep in mind is when a big company like this lays off thousands of employees, it's not going to show up in the fundamentals at all for another, I'd say, 6 months. Because they have severance for 3 or 4 months, and then another 2 weeks of severance for every year they've worked at the company. So that can add up to 6 months of severance, plus they still pay out their stock-based compensation and other things that they're owed, right? So a lot of this takes time to work its way through the metrics. Google just laid off a lot of employees, but I wouldn't expect the stock-based comp to drop this earnings. In general, right now, I think that Google is undervalued. I think the company has more upside than downside. And I don't think that we should judge the upcoming performance of Google by how Snapchat does. Now, next up, we have Starbucks, which I think, again, these type of food companies, quick service restaurants that are very high quality, whether it's McDonald's or Starbucks, I think they're going to do very well. Starbucks is getting closer to my fair value of $115. It raced up to $108 per share. And I was buying the company at $70, $80, $90. So I did trim my position a little bit, but I still have a lot invested in this company. It's a pretty significant holding. I'm still bullish on it. I think the company's going to do well. I think the earnings report has more upside than downside. And then finally, we have Atlassian. This is another company that I think is more speculative. I think another concern is even though this company does look profitable by the free cash flows, it's one of those ones where the stock-based comp really just crushes all the profitability. It's completely gone when you factor that in. It doesn't look quite as attractive. And over the past couple of years, you can see the stock-based comp actually growing at as much or even faster than their free cash flow. So that's something that I don't like, and that will make me remain firmly on the sidelines for this company. So I think that one has a strong possibility to disappoint not so much with the past quarter, but more with their guidance. So that's it. That's a lot of the earnings reports coming up this week, the most important ones. And I'll be giving my reaction to these. So if you haven't, follow along, subscribe to the channel. I'll be reacting and going in depth in Amazon's report, Meta. I'll look at Spotify's and McDonald's and Google's and all of these companies. So follow along. We have a lot more to follow this week. See you in the next one.